In the spring of 2002, a woman sat alone in a dark office in Clinton, Mississippi, long after everyone else had gone home. She was pulling financial records that her boss had explicitly told her not to look at. Her name was Cynthia Cooper. She was the vice president of internal audit at WorldCom, a telecommunications giant that employed 85,000 people and, at its peak, reached a market valuation of $180 billion. As the head of the company's internal watchdog function, Cooper was no junior employee stumbling into a mistake. Running a secret after-hours investigation into her own superiors went against every protocol she was hired to enforce, and it carried immense professional risk. But by refusing to let a seemingly small anomaly go, she would eventually document the largest corporate accounting fraud in American history. Her findings prove that the most severe threats to massive institutions often hide in plain sight. The path to that discovery started with a market collapse. By the early 2000s, the dot-com bubble had burst, devastating the telecommunications sector. Behind closed doors, WorldCom was bleeding money. The company was run by CEO Bernie Ebbers, a former basketball coach who had built WorldCom through a relentless string of corporate acquisitions. Ebbers was deeply leveraged. He had borrowed hundreds of millions of dollars to fund personal investments, using his own WorldCom shares as collateral. This created a precarious financial trance. If WorldCom's stock price dropped, the collateral value of his shares would fall, triggering a massive personal default. The only way to keep the share price artificially high was to ensure the company's reported financial performance looked spectacular. Cooper caught the first thread of this operation while doing routine audit work. She noticed a massive $2 billion capital expenditure sitting in the company's accounts. Capital expenditures are supposed to represent tangible things: equipment, new infrastructure, actual assets. This entry corresponded to absolutely nothing she could identify. When she raised the issue, she hit a wall. WorldCom's chief financial officer, Scott Sullivan, politely told her she was looking at things she didn't need to look at and instructed her to stop. The company's prestigious external auditors, Arthur Anderson, reviewed the entries and assured her everything was entirely appropriate. Cooper had perfect professional cover to drop the issue right there. Her direct superior had ordered her to stand down, and the outside experts had officially signed off. She faced a choice between comfortable compliance and isolation. Stepping back into the dark to investigate her own leadership meant risking her career on a suspicion the experts told her was wrong. Instead of stopping, Cooper quietly assembled a small team of auditors she trusted absolutely. They began pulling detailed records after the building emptied out for the night, working through weekends and keeping their findings completely secret, terrified that if executives caught wind of the audit, the underlying evidence might be destroyed. What they were trying to untangle was a highly sophisticated manipulation of a very basic accounting principle. This chart shows how expenses are categorized. Every business has operating expenses, the day-to-day costs of keeping the lights on. In accounting, you record these costs immediately, subtracting them directly from your current revenue, which instantly lowers your reported profit for that quarter. Then you have capital expenditures, investments in long-term assets that generate value over time. Because these assets last for years, you spread their cost out over multiple future periods. If you take a massive, immediate operating expense and secretly reclassify it as a capital expenditure, you remove that cost from today's balance sheet. Your current profit artificially shoots upward. This is exactly what WorldCom was doing with its single largest operating cost. The company paid huge network line fees to other telecoms to route calls across their physical infrastructure. These line costs were clearly day-to-day operating expenses, but executives were deliberately reclassifying them as capital assets. By shifting current expenses into the future, WorldCom was continually borrowing future losses to fabricate present-day success, deceiving their investors quarter after quarter. The deception was nearly invisible to outside observers. The fraudulent entries were perfectly formatted, appropriately labeled, and fragmented across thousands of different subledger accounts, so that no single line item looked out of place during a surface-level review. The team spent weeks tracing these entries deep into the systems until they found their proof. By demanding the specific source documents for these supposed capital assets, they demonstrated definitively that there were absolutely zero underlying receipts or business justifications to support them. As they dug deeper, the scale of the manipulation expanded far beyond the initial $2 billion. Ultimately, the team uncovered an $11 billion fabrication, engineered directly by CFO Scott Sullivan. The reality of the numbers shifted the investigation from a technical accounting puzzle to a profound moral crisis. Cooper realized she was holding documented proof that would inevitably destroy the company she worked for. Knowing her boss was heavily implicated, Cooper bypassed Sullivan entirely. She took her evidence straight to the Board of Directors Audit Committee. The committee immediately hired independent auditors from KPMG, who verified her findings in a matter of days. The collapse was swift. On June 25, 2002, WorldCom publicly admitted to the massive accounting irregularities and fired Sullivan. Less than a month later, the company filed for the largest corporate bankruptcy in American history up to that point. The fallout devastated the lives of the 85,000 employees who faced layoffs and watched their retirement savings evaporate. Investors lost billions. Bernie Ebbers would eventually be convicted of securities fraud and sentenced to 25 years in federal prison. In the aftermath of corporate disasters, the person who exposes the fraud is frequently blamed by colleagues for causing the collapse. It is a psychological defense that ignores the executives who built an empire on a lie, punishing the person who finally turned on the lights. The timing of the disclosure compounded its impact. Coming just months after the collapse of Enron, the revelation of a second multi-billion-dollar fraud at WorldCom created irresistible political pressure for federal intervention. Congress rapidly passed the Sarbanes-Oxley Act. This sweeping legislation required CEOs and CFOs to personally certify their financial statements under threat of criminal penalty, and it established robust new legal protections for whistleblowers. The strict governance framework that every public company operates within today is a direct descendant of the specific evidence Cooper dragged out of WorldCom's servers. For Cynthia Cooper, the personal aftermath was complicated. She was celebrated globally, named one of Time magazine's Persons of the Year for her actions. Yet inside her own company, she was never given a raise, and she found herself quietly isolated by parts of the corporate community. Her story defines moral courage in a professional setting. It is continuing to investigate despite the severe personal risk, because the consequences of ignoring the problem are simply too great to bear. Whistleblowing exacts a heavy toll, and it rarely looks like the movies. But the entire global financial system is measurably safer today because one woman, sitting alone in a dark office, refused to look away.